welcome. We are working on chapter 10. Chapter 10 is a little bit longer chapter, and so the two videos for this will probably be a little bit longer. And in fact, what I've done is decided to write out some of it, a lot of it, before we actually, instead of me writing as I'm talking about it. I am trying to bring out the most important things from the chapter. These are the things that I would test on. So I will do a video on this first part, the second part, and I'm contemplating doing a video on some of the homework because the 210 on in-person class actually had quite a few questions about the homework. So I might add an additional homework video as well for those people who want it. Okay, well, let's talk about it. We've moved through the balance sheet. We did cash. We've done inventory. We've done accounts receivable. And now we're working on the long-term assets. So we're still on the asset side of the balance sheet. We're now talking about the long-term assets. Specifically, this first part, we're not talking about every type of long-term asset. The first part of this is we're going to talk about what they call plant assets. Basically, these are physical assets that we use. Now, remember, a company has assets, not to collect assets. They use assets to help them generate revenue. So inventory is an asset, and obviously we buy inventory in order to sell it. But there are long-term assets that we buy that help us run our business, but we don't intend to sell it. And those are some of these long-term assets. So a long-term asset, first of all, it's not current, meaning it's not inventory, it's not cash, it's not accounts receivable. We also call it sometimes a fixed asset because typically the old saying was it was affixed to the ground. It was a building, it was a piece of equipment, something like that. But a truck can also be a fixed asset. Another term for some of these physical long-term assets was plant, property, and equipment. And in fact, you would see the abbreviation PP&E quite often. So what are they? They're assets that have physical substance. They're used in operations, but we don't actually sell them. So they do help us generate revenue, but they are things we keep over a long period of time. So the kind of two things we're going to cover in this particular video is, so we're going to look at a couple of different types of assets, plant, property, and equipment. And we're going to look at what all is included in when we buy one of these assets. What do we include in the cost? And the thing is remember when we talked about inventory, we said that freight in gets included in the cost of inventory. In other words, when we buy something, however much it costs us to ship it to ourselves, in other words, for it to be ready to be sold, we would also include that as part of the inventory cost because that's a cost we need to recoup. So something similar with long-term assets, anything that we need to pay to get a long-term asset ready for use, we're going to include in the original cost. So it'll always be the purchase price, but it'll be the purchase price but plus a bunch of other things. So let's go ahead and look at a couple of these categories. So land. Well, we have the purchase price, then any of these closing costs necessary to actually make the transaction happen, title fees, attorney fees, real estate broker commissions. Additionally, anything that we need to do to the land to get it ready for whatever its intended use is. If we have to clear it, drain it, grade it means making it flat, taking down old buildings called raising. Now, if we took down an old building and then we sold off some of the materials that we got, well, that kind of offsets. That would be money coming in. We pay to take down the building, but if we were able to sell off some of the salvage, that would reduce the land cost. Now, there are some things that we might also want to do. We might want to do some driveways, parking lots, fences. These are not part of the land in that they're not necessary to make the land ready for use. And so this is kind of a fine point. What is necessary and what is not necessary? Well, some of these things that are nice to have, yes, we'd like to have a parking lot, like have fence or landscaping, but is it required by the city or is it required by the county for us to put those things in? So the county may require us to put in a sewage system or maybe require us to put in sidewalks, but the county doesn't require us to have landscaping. So landscaping would be one of those things that we'd like to have, a nice to have, but unless it's part of a county or city ordinance for us to put it in, then we would put it in a different category than land. We would put it in another asset category called land improvement. So nice to have, but not mandated. How about buildings? Well, anything, so stores, offices. I got too many things on my table here. Stores, offices, factories, warehouses. So, of course, always the purchase price, closing costs, attorney's fees, commissions, anything necessary to close the transaction for the business. If it's an older building and we're remodeling it or repairing it in order to make it fit for our use, that would be part of the building cost. If it's a new construction, architect fees, permits, and even if we were the interest cost to finance the construction, that would be part of the cost that would go into the building. If you watch any of these TV shows, house flipping shows on HGTV, a lot of times they do talk about, the interest cost to finance it. In other words, we don't want to be in the flipping stage, but, 6 months, because all those interest fees add up. So if you're interested in those type of videos, you will see that as part of their discussion. Equipment. So equipment can be any sort of thing. Remember, it's things we're not selling to the customer. It is things that we are using to run our business and generate revenue. So furniture, machinery, computers, trucks, those sort of things. It's always the purchase price, sometimes sales tax, freight charges, meaning freight in. Also, if we've got a big piece of machinery, we have to pay to assemble it, install it, to test it, to run the first testing, to do the initial training. All those things are necessary to get it ready for use, or at least its first time use. When we talk about machinery, there are some things that are annual recurring things. Like, think about a truck. We have insurance costs for the truck, and we have to buy licenses. If we've got a business truck, we would have to get some sort of special license. But if those are annual and recurring, then those are separate expenses. They weren't necessary to get it ready for use. There are going to be some costs that we have to pay during the normal useful life of a piece of equipment. And these things are divided up into two categories. They're either ordinary repairs, as an example, oil change for a truck, you're repainting the building, replacing machine parts. Those are just expenses. I should just point out that these are just expenses that we expense along the way. However, if we make a significant change to a piece of equipment, in other words, that the outcome is that we increase the usefulness, we increase the life expectancy, usage, or efficiency, then we go ahead and, now what is this word, capitalize? All of these costs that we've been talking about, the word we use is capitalize. I actually see that I had put that up here and I forgot to mention it. So all of these additional costs, we use the word to capitalize. We say, here's the purchase price of the land. We're also going to capitalize all these other costs, meaning we're going to add all these other costs to the purchase price, and that will be the total land price. So capitalize is the word when we say, here are a bunch of other expenditures that we're adding to the price of the asset. So here, if we do some major change, like let's take the truck again. Let's say we do a complete engine overhaul after 10 years. Well, that increases its life expectancy, its usefulness. So the engine overhaul wouldn't be just a normal, ordinary repair. It would be something that the cost we would add to the value of the truck. Or let's say we changed the truck from one type of truck into another. It was a flatbed truck, and we decided we change it into a truck that had a cold compartment on the back. Well, that would change its use. And so we would capitalize all those. So just make sure you understand that the difference between an ordinary repair versus an addition or improvement, one gets expensed, the other one gets added to the value of the asset itself. So these are the three main categories of physical assets we're first talking about: land, buildings, and equipment. Now, we've talked about what all goes into the cost of the equipment, or the cost of the assets. And then we have to think about this word. We've kind of referred to it a few times before, depreciation, but now we're actually going to learn what depreciation is. The important thing is, think about when we have inventory. When we sell inventory, remember that the journal entry is to credit inventory, meaning inventory goes down, and we debit COGS, cost of goods sold. Cost of goods sold is an expense, meaning for the sale, that was the thing, that was the expense necessary to make this, to generate the revenue. Well, these other things, a delivery truck or furniture or, the building or the land may not directly generate revenue, but it is part of the whole process. We need a store to have customers come in and look at things. So we don't, when we buy the store, we don't put all of that cost of the store, or if we buy a piece of machinery or a truck, we don't put all of that cost in 1 year because we're expecting to use that piece of equipment or that asset over many years. So what do? Well, if you've got a truck, you're going to say, okay, if this truck lasts for 10 years, I'm going to spread the cost of the truck over 10 years, meaning the important thing is to realize that we paid for a truck. It is going to allow us to generate revenue, or it's going to help us run our business. And so according to the matching principle, we want to match all the expenses in the same period that we're getting use of the truck. So if the truck is useful to us for 10 years, we're going to put a little bit of the expense of the truck into each of those 10 years. So the whole idea of depreciation is not to reduce the value. It is not an asset valuation, although it sort of looks that way. It is how to allocate the cost, how to allocate the expense over the useful life. Now, when we expense inventory through COGS, well, we expense it immediately. We expense the whole bit of inventory because we're selling it. But we don't expense a building or land or a piece of machinery immediately. We spread it out over time. So just remember, it's allocating the original cost of the item over the period of time that we're going to be using it. It's a non-cash expense, and it's our best estimate of usage. So it's not always going to be precise, but it's just our best estimate. There are 3 factors when we're looking at depreciation. We need to know the cost, the original cost, and in fact, we call this the historical cost, the useful life, and then the salvage value. Now, what is the salvage value? It's not very prudent for a company to buy a piece of machinery, and if the people selling the piece of machinery say, this machinery is probably good for 8 years, and then it starts to have a lot of problems. Well, the company should be thinking about, at the 5 or the 6 year mark, replacing that piece of machinery before it becomes a problem. So salvage value is basically the company just being smart about its equipment and saying, we don't want to use it all the way up till the point where it breaks down. We want to use up the majority of the value and then maybe sell it on the used hand market. And that salvage value is basically what we want to, where's the point that we want to use a piece of equipment up to. So if we've got a truck that's worth a certain amount of money, let's say $10,000, maybe we say, okay, we're only going to depreciate it. We're only going to use it for the first $8,000 worth of its value, and then we're going to try and sell it and replace it. So cost, useful life, and salvage value are the 3 items we need to know to do depreciation. There are 3 methods. Now, the 3 methods, remember that depreciation is an estimate of its usage. Well, we don't have these 3 different methods just to have 3 methods. We have these 3 methods because we're trying to model the real life usage of assets. And assets get used in different ways. And so these are the 3 primary ways that we think most assets get used. Remember, it's an approximation of how they're actually being used. The first one is straight line, meaning our anticipation is an asset has a continuous and a relatively equal usage. So let's say we have a delivery truck. Yes, it might be up and down how much we actually deliver, but we're pretty much using that truck continuously. Or we have a piece of furniture and we have people working in the store and or in the office, and therefore people are there 5 days a week and they're using the desk, and so the desk is getting relatively continuous and equal usage. So we would use a straight line method. Now, there are assets that get either intermittent use, we use them sometimes, but not all the time, or when we use them in a different amount. So think about, let's say we have a piece of equipment that is only used for 2 of our 5 product lines. So how much we use this piece of equipment depends upon customer orders. Maybe 1 year we don't get very many orders that require this piece of equipment, whereas other years we get more. Or maybe it's seasonal or monthly or something like this. So instead of us anticipating there's a continuous and equal usage, we say it's either intermittent and or unequal usage, and we have a different way of approaching the depreciation, the cost allocation. The third way is declining balance. Sometimes we have an asset that when we buy it, its majority of its usefulness is the first year or 2 or 3 after we buy it. And even though we can continue using it for 5, 6, 7, 8 years, perhaps the thing is most valuable to us when it's new. And so what we do is we front load the expense into those first couple of years. And it's not as big a deal these days, but it used to be that, as an example, computers, the computer chips were always increasing in power every 2 to 3 years. So if you bought a computer, yes, you could use a computer for 5, 6, 7 years, but really it's the majority of its usefulness when it was new was when you got the main use out of it. And then after that, it became a little bit older and not as fast and whatnot. So there are various types of assets that are front loaded, saying we get the majority of the usefulness in the beginning. Okay, so we have now a definition of what goes into the actual value of the assets, and we have got 3 definitions of methods. So let's go ahead and work through a couple of an example of each of these 3 different methods. Let's start off with the straight line, and let's say that we have, get my pieces of paper here. Let's say we have a truck that's $13,000 and we are going to use it up. We're going to use the majority of the value up, but we're going to stop at $3,000 and try and sell it. And remember, this isn't exact. This is just our best guess of how we're going to use it. So if the total bar here is $13,000, and we're going to say we're going to use it down until we hit the 3,000 mark. Well, what is this area? Well, it's 13,000 minus 3,000. We're going to use up 10,000 of it. That's how much we're using. And we call this the depreciable value. The amount that we're going to depreciate. Well, how we go figuring out in straight line is that, remember, we're going to consider anything with a straight line as having a continuous and fairly equal use. So what it looks like on a graph is, here we've got a number of years, so it's 1 through whatever, and here we've got the value, the dollars. So what we're starting off is we're going to depreciate a total of $10,000. So if it starts off here, it's going to depreciate approximately the same amount every year until we've depreciated it all. And that's why we call it the straight line, because the graph of its depreciation is that way. So how do we figure it out? Well, we take the historical cost minus the salvage value over the useful life. And that's going to be the depreciation per year. And I'll abbreviate depreciation DEPR. So in this case, what do we have? We've got 13,000 minus the salvage value of 3,000 over the useful life of, I didn't say it. So it's 10 years. Let's say it's 10 years useful life. So what do we get? We get 10,000 over 10 years. Or 1,000 per year. So let's take a look at how we would write this out as far as a journal entry. So at the end of the year, this isn't one of those adjusting journal entries, we would say, okay, we need to knock off 1 year of depreciation. Well, since we've already calculated as it's going to be 1,000 per year, we're going to, well, first let's set up, we've got this truck T account, and we have it as 13,000. Now, what does the journal entry look like? Well, depreciation is an expense, so it's a debit, and it's 1,000 here. And what is the credit? Well, you may think that we're going to write down the truck directly, but that's not actually what we do. We actually keep a separate account, and it's called accumulated depreciation. Accumulated depreciation. And what this is, and we've encountered this sort of thing before, it's a contra account. Just think about the allowance for doubtful accounts, and there's the sales return and allowance. Those were all accounts that we didn't directly affect the target account. We kept a separate account where we tracked things. So here, this would be for year one. And I would look at that and say, okay, I originally bought the truck for $13,000 and I've used up $1,000. So if this was year one, this journal entry, well, what about year two? It would be the exact same thing. Depreciation expense, accumulated depreciation, 1,000, 1,000. Now notice the depreciation expense goes through the income statement and it gets recorded as an expense every year. The accumulated depreciation adds up. It's like a running total. So that each year we'll have just $1,000 going through the income statement, but we will be tracking the total amount of depreciation through this accumulated depreciation. So after year two, there's actually 2,000 in the accumulated depreciation. And this allows us to see how much we think the asset is worth to us. And we call that book value. Book value, let me write it out. Book value is the historical cost minus the accumulated depreciation. So here, the historical cost is $13,000. You notice we haven't changed that. After year two, we've depreciated it for 2 years, which is $2,000. So the book value is going to be $11,000. Now, you notice if we're going to be doing this over 10 years, right? We're going to be depreciating over 10 years. So after 10 years, it's going to be $10,000. So historical cost minus accumulated depreciation would be $13,000 minus $10,000, which would leave it at the salvage value of $3,000, which is where we're going to stop depreciating it. So just remember that the accumulated depreciation is a contra account. It's a contra asset account. And it's there to track the depreciation or how much we've used the truck by. Now, notice here that we've talked about this $1,000 a year. Well, we're basing it on this time frame of year as if we purchased this truck on January 1st. If we purchased it on January 1st, we can depreciate it for a full year's worth of depreciation. But what if we didn't purchase this on January 1st? Well, we'll have to prorate it. So for example, if we bought this on July 1st, which is the beginning of the 7th month, meaning it's halfway through the year, that first year, I would say year one, we would say the depreciation is going to be $1,000 a year, but we didn't do it for a full year. How many months? All of July, August, September, October, November, December, January. I'm sorry. All of July, August, September, October, November, December. So 6 months. And I actually use my fingers because there's a lot of times where you miscount. Or, for example, if I said we bought this on October 1st, and I said, well, how many months is that? Between October 1st and the end of the year, you might say 2 months because October is month 10 and December is month 12. But in fact, we're talking about all of October, all of November, and then all of December. So that's actually 3 months. So here, 1,000 a year times 6 out of the 12 months. So for the first year, we would have a depreciation expense of 500. We would just prorate it and the accumulated depreciation of 500. Okay, so that's an example of straight line. Let's go ahead and do an example of units of activity. This is the one where we said perhaps it's not continuous usage, or it's intermittent usage, or it's unequal usage. So let's take an example of a machine that is used sometimes, it's not used for every product line. It's only used for certain product lines, and therefore it's based upon customer demand. So maybe we use it more times than others. So if we do this, rather than figuring out a total per year, because that's sort of a continuous usage, we break this down and say, okay, let's take this same truck and we say, well, we always use this truck. It's still going to be a purchase price of $13,000. We're still going to say $3,000 as far as salvage. But rather than saying it's good for 10 years, we may say something like it's good for, maybe this truck is good for 100,000 miles. So a lot of times units of activity, we use machine hours or distance or something like that. So we do the same thing. What we do is we figure out, okay, 13,000 minus 3,000. This is the historical cost minus the salvage value. And we do it over the units of activity, which is going to be 100,000 miles. So what do we get? We get 10,000 over 100,000. And so we come up with the number. We're going to depreciate this at a rate of 10 cents. This is in miles. We're going to depreciate this at 10 cents a miles. And 10 cents, not miles, 10 cents per 1 mile. So you can see this makes it very easy. All we have to do is check how many miles was this truck driven in any particular year or any particular month, and we can figure out what the depreciation is. So if we, in year 1, we drive it 15,000 miles, we're going to say that is going to be depreciation expense. Well, 15,000 times 10 cents is going to be $1,500. And the accumulated depreciation is going to be $1,500. Now, the problem, I don't want to say the problem, the additional thing we need to pay attention to with units of activity. You notice here with straight line, it comes out even. It comes out exactly as 0 because we know how many years we're depreciating it, and we're depreciating it by the same amount every year. So at the end of the time frame, it comes out to exactly the right amount. With units of activity, it can go over. So what we need to do is we need to keep depreciating this until we hit that the total accumulated depreciation can only be 10,000. So let's say year 2, it's 40,000 miles. We would do depreciation. And so if I was keeping track of the accumulated depreciation here, it'd be 4,000. And the accumulated depreciation would be 4,000. So let's say in year 3, we drive it 60,000 miles. Well, 60,000 miles would be 6,000, right? But you notice that would bring us over our 10,000. So we can only depreciate it. Remember, we're depreciating it in this way down to the $10,000 amount. I mean, we're depreciating it down 10,000 to where there's 3,000 left. So what we need to do is at the end of the units of activity timeline, we just need to make sure we don't go over. So even if we use it for 60,000 miles, we're only going to depreciate it by what's left. So here, this is 40, this is 5,500. We can only depreciate it by another 4,500. So we would take depreciation expense of 4,500 and accumulate depreciation. And that would allow us to hit the mark on activity. Now, if we keep using this particular vehicle or this asset beyond its depreciation point, that's fine. It doesn't break the rules. All we've done is try to assign the cost. Remember, this is not a valuation exercise. This is just trying to spread out the cost. And so maybe we didn't we didn't estimate it perfectly in the beginning, but we've done a best job of trying to spread out the cost over the useful life of the truck. So maybe we ended up using it a whole lot more of that. And as long as, if we continue to use this truck for time afterwards, we don't have to depreciate it anymore. It just sits on the books as asset of 13,000 and accumulated depreciation of 10,000, meaning a book value of 3. Let's take a look at the last one, and that is going to be double declining or declining balance. Now, there's all different types of declining balance. This is one that, remember, the declining balance is where we front load the expense. Most of the time we talk about double declining, meaning it will go twice the rate of the straight line. So if you remember our truck, we're depreciating the truck over 10 years, or over 10 years, what we're actually doing is we're doing 10% per year. So double declining would double that to where, so double would be at a rate of 20% per year. Now, how do we calculate this? We calculate this, and this is important because sometimes you get stuck on the homework if you don't have the correct formula. It's 20% of book value. Now remember, book value equals historical cost minus accumulated depreciation. So make sure you have that. So if we're running our same thing again, our truck is 13,000. Salvage is 3,000. The depreciable value is 10,000. Now, for the first year, what is our amount that we're going to run through depreciation? Well, the book value is going to be 13,000. Remember, historical cost minus accumulated depreciation. So 13,000, and we haven't depreciated it at all yet. So that equals 13,000 times 20%. So this is going to be equal to 2,600. And the next year, so our journal entry would be depreciation expense, 2,600, and it would be accumulated depreciation of 2,600. Well, now we have in year 2, we have some depreciation. So it would be 13,000 minus 2,600 equals 10,400 times 20%, which would equal 2,080. And you would see in your accumulated depreciation, you would have 2,600, and then you would have 2,080. So you can see this is, if we remember, we did this whole same thing with straight line, and straight line was 1,000 per year. So you can see with the double declining, we're really front loading it. And so therefore our depreciation expense would be 2,080, and our accumulated depreciation would be 2,080. Similar with units of activity, we can't go below a total amount of accumulated depreciation of 10,000. So we'll get down here to some point to where we have to stop, just like we did with units activity. But remember that the way to do it is to take the book value times the percentage, whatever the declining balance percentage is. So here we end up with 20% times, because if we were using a 10-year, if you were using a 5-year, well, that's the same as 20% per year. So double would be 40%. So what ends up happening? Well, it looks like we have a bunch of different numbers, but it's really just a timing issue. So straight line would take the value down to here. the units of activity would be sort of like this. And then the double declining front loads it to where most of the expense is going to be up here, and then it curves down and hits here. So it all works out the same way. You end up depreciating it down to its proper place. And it may not actually be the same year. They may hit at different times. But those are the three methods that we're going to go through and for physical assets. And those will be the ones that are in the homework. Okay, I will see you on the next video where we talk about the rest of the chapter. It won't be as long a video, but there are a few more things that we need to cover.